In Case A, we follow Simon Aurora and his brother Bobby through their decisions in seeking help to grow their retail business beyond what they thought was feasible to do on their very own. They wanted to help scale the business before retail competitors could catch up with their innovative strategies. The family negotiated a very interesting ownership structure in that they sought to sell a significant portion of their stock to a private equity firm upfront, yet also retain a significant minority interest as well. Trusting that the private equity firm would exit ultimately, leaving the family back in control of an exponentially larger and more successful company, whilst partially cashing in to create enough wealth to be financially independent. The second case, Case B, is devoted to what was done and how it all turned out in the end. About B&M. The family had successfully run their Liverpool, England-based general merchandise discounter for 8 years. The company had grown sales at an annualized rate of 49%, while improving EBITDA margins each and every year. Their advantage was that they offered greater value to the consumer because they were able to source products better than their competition. They concentrated on a limited assortment, they bought deep volumes, they built exclusive and strong relationships with supplier manufacturers, particularly in China, where the family had many years of trading experience. And most importantly, B&M offered a price that was compelling to the shopper. After experiencing such rapid growth, however, B&M found itself much in need of operational transformation to keep up with their dizzy pace of expansion. The company needed to upgrade its operations throughout to keep up with the velocity of store openings and improve logistics to support growth as well as margin. IT and management practices needed renovating to match the challenge of exponential expansion. And the company would require more capital to fund its many opportunities. Moreover, the company would have to break out of its North England stronghold and expand across the entire United Kingdom. Further, the Auroras had been keen on pursuing overseas expansion, but had no experience in running a business outside of the UK. To address these opportunities and growing pains, the Auroras considered several options. An initial public offering to raise capital, perhaps bring in a retail consultant group to advise on operating improvements, recruit a chairman of the board with relevant experience to help that was retired and could pitch in on a major basis to improve the business, or to attract a private equity investment wherein the PE firm has real operating know-how around the challenges that B&M faces. After weighing pros and cons of these approaches, B&M decided to pursue selling equity to a private equity firm, who would then have skin in the game. As we recall, the caveat being that the family wanted to continue to own a substantial percentage of the equity, and they wanted to substantially cash in at the same time. Simon knew that if everything went well, the family would end up owning de facto control of the business after the private equity firm exited. This was the option instead of selling the company outright, which many of the private equity firms, of course, would push for. Case A ends with the family evaluating several private equity firms in order to select the most suitable partner. In Case B, students get to see what actually happened. B also considers the deal from the private equity firm's point of view and looks at the risks and rewards of a similar type of arrangement. The cases examine how private equity firms and family businesses can reach mutually satisfactory arrangements, considering that private equity investors need to have exits and return capital to investors, and families often desire to remain in control of their businesses for future generations. B&M is a successful family-owned enterprise where the family wants to scale, where it is threatened operationally by growing too fast, and is hesitant to go it alone, needing more capital, faces regional rollout with little experience, and needs cross-border know-how. Students explore the ability of certain private equity firms to add value operationally as transformative ownership partners, furthering the family objectives while simultaneously enjoying significant returns for their investors. Participants must identify the priorities of B&M's ownership and establish selection criteria based on the alignment of incentives, interpersonal dynamics, and the abilities of the firm to offer solutions operationally to support building scale. In so doing, students will gain an appreciation of the relative strengths and weaknesses of different private equity firms. Moreover, students will gain an appreciation for the dynamics unique to family businesses, as well as some of the challenges faced by a rapidly expanding business: need for capital, expertise, logistics, systems, etc. The following could be assigned to students to help them prepare for class discussion. What resources or capabilities is B&M seeking to gain through a partnership? Why has Simon Aurora decided that a partnership with a private equity firm is the most promising solution available? How were the Auroras able to sell control of B&M, but in a few years end up with de facto controlling interest in a publicly traded company, having had the private equity firm exit entirely? Is this common? From the perspective of a private equity firm, how do you convince a family owner that you have their best long-term financial interest in mind, whilst needing to exit within a matter of years? When this case is taught at INSEAD, Tuck, and UC Berkeley Haas, the following is assigned and presented in class. Taking the perspective of Simon Aurora, develop 3 slides to share your perspective with your brother and advisor. First, summarize your objectives in partnering with any private equity firm. Importantly, what terms should be insisted upon by the Auroras in the shareholder agreement, and why or why not will the private equity agree to such terms? Second slide, develop criteria to evaluate potential private equity partners. Rank the firms listed in the case based on those criteria. The third slide, articulate a due diligence plan for the Auroras to assess these firms. Realize that you have no restrictions and will be allowed free rein to tap any information and any source that you deem relevant. When it's all said and done, we hope you enjoy the case as much as we enjoyed writing it.